Good afternoon, everyone. Thank you for joining us. Today we've got Kenny and Yanni from Arnott Capital to go through how they're positioned at the moment and how they see the future in this obviously uncertain environment. After having a pretty quiet last couple of years, last 2 months have been particularly pleasing for investors in the fund. So I think people's patience is starting to be rewarded. If you'd like to ask a question, the only way to do so, I think at the bottom of your screen is you can type Kenny and Yanni a question and they'll either answer it during the call or at the end we'll go through the questions that have been asked of them. So Kenny and Yanni, over to you.
Okay, thanks Andrew, and thanks everyone for joining us. I'm just going to run through a reasonably brief presentation and then open it up to Q&A. So just to background on our process and what we're looking for with our strategy, we're trying to invest in uncorrelated opportunities where the upside far outweighs the downside, and those opportunities will perform through different market cycles. And that's backed up by our track record of 18 years where you can see significant, these are quarterly returns, significant quarters of really high returns and very, very few drawdowns. And you know, amongst managers, it's very easy to produce these sort of returns. It's very, very rare to be able to produce these sort of upside returns with these limited drawdowns. The way that we're currently looking at the market and how we're currently positioned within the portfolio, coming back to the idea, what we're trying to do is create a collection of idiosyncratic risks which are not necessarily correlated with how the market will trade. Our largest position is uranium. I'm going to come back and talk about that in a moment. Second largest position is agriculture, which Yanni's going to run us through. We've got some core long holdings, and against that we've got what we call core shorts and some defensive shorts as our major component of the equity book. And then we nearly always run a macro book, primarily made up of some sort of equity index futures, which is currently running short. So I now just dive into uranium, and I might just start with this little cube. Hopefully you guys can see it. If this was uranium, this would weigh 3 kilograms, and this amount of uranium, as you can see here, will power 150 Australian homes for a year. The uranium thesis, which we've been long and, shall I say, a little bit early for probably about 18 months now, has really been based on 7 characteristics. China's growth is enormous. Nuclear is proving to be the only way to generate green baseload. We're seeing increased new Western reactor builds and life extensions on existing ones. And more recently, policy uncertainty in the US has led to the US utilities drawing down on their inventory. On the supply side, the cost of production almost twice its current selling price. And as that has been problematic for producers, we've seen 229 million pounds come out of the market since 2017. In fact, the way the current market sat prior to March was that the only reason the market was being in deficit was from drawing down inventory supply. Due to mine closures on COVID-19 issues, we've now seen about 50% of global production cut for a temporary period, which has put a real catalyst under the market right now. This chart summarises what I look for and what we've put on. Over a long period of time being in markets, when you see commodity markets move from deficit to from a supply to deficit imbalance, invariably the price move around that is not necessarily very orderly. The overlay of the COVID-19 just shows you how dramatic the reduction and change in supply-demand balance is right now. And on the back of that, we've seen the uranium price move significantly in the last month. China is going to be a very, very large consumer of nuclear energy by the 2030s, and they're typically buying 7 years in advance, so this is an issue right now. We see similarities with iron ore, and despite increasing supply, iron ore was able to move from 12 to 180. I think that China could have a similar influence on the uranium market. It's very interesting as the world's gone green, led by Europe, that we've all moved into alternate sources of energy, and none of these have really been able to effectively manage baseload power. Uranium is now becoming, or nuclear power becoming the clear source of green baseload power. That's happening at a point where all around the world we're seeing policymakers and influential people shift on their views on uranium. Europe, Australia, US, Germany. Germany's interesting, of course, because they're actually currently slated to cut down their uranium power generation. They're currently short power, buying their power from France, who produce it using nuclear power generation, ironically. Since the 70s, we had seen no increase in builds all the way back here. And right now what we're seeing is we're seeing a lot of new builds in the West, and we're seeing a lot of extensions on existing reactors. That's happening at a point where the utilities uncontracted uranium going into the future is decreasing rapidly. When the market's gone into contango, meaning the spot price is higher than the forward price, that's really important because for the last 5 years, we've seen traders in the market buying spot, doing a cost and carry and delivering to the utilities in the forward market. They can't do that now and they're short caught. So you've just got these added second derivative effects, knock-on effects from the COVID-19 supply shortage disruption. And on the supply side, this is just a chart going out to 2025, where it is estimated that spot had to get to between $60 and $70 to incentivize enough production to come back into production to meet the deficit. Again, this is all prior to the COVID-19 production cuts. While people talk about that coming back, I don't think it's going to come back as quickly as people think. So that's our uranium thesis. I'm now going to hand over to Yanni, who's going to talk about our ag thesis.
So thank you, Kenny, and hello, everyone. A sector in equity markets that we're finding extremely attractive at the present moment is agriculture. The primary reasons why we're attracted to agricultural equities is that this is a sector that marches to the beat of its own drum and is largely decoupled from the traditional business cycle. The sector as a whole is deeply unloved by the investment community, as the Australian drought has seen companies in this sector consistently deliver downgraded earnings, resulting in steep share price declines over the past couple of years. And most importantly, why we're attracted to this sector is we're beginning to see the emergence of green shoots as growing conditions across Australia improve. Heavy rainfall through the early part of 2020, coupled with forecast median rainfall above average for May, June, July this year, point to rapidly improving farming conditions in Australia's most important growing areas. In ABARE's latest agricultural report released on Friday, they are now forecasting a return to average crop harvest this winter. So to put this in perspective, the top chart to the right illustrates that 2019's winter crop harvest was 28% below the near-term average. So a return to average in the winter of 2020 would see a material increase of production of approximately 35%. So should these forecasts play out, markedly improved growing conditions will drive a material uplift in sector earnings. However, despite an improving outlook, the market is currently pricing the sector for a continuation of the misfortunes of recent history and depressed earnings to persist into the future. This is where we see asymmetry in the trade. Should 2020 prove to be a reversal of industry fortunes, we'll be owning these equities at the beginning of a cyclical upswing, driving the upgrades through late 2020 and 2021. But if our view fails to play out and conditions fail to improve through the winter period, negative outcomes are already largely reflected in these security share prices, limiting our downside. So in this space, we own Costa Group, GrainCorp, Inghams and Nufarm, as we see all these securities eliciting the greatest upside from a reversal in sector fortunes. So in the interest of time, I'll quickly move on to our long gold thesis and skip the consumer cyclicals. And if you've got any questions on that, I think you all have our slide deck, so you can come up in the Q&A or ask us after this. So moving on to gold, we view this asset class as a structural long with multiple years of price appreciation ahead. The reason being, quite simply, gold is a fiat money hedge. With central banks globally printing copious amounts of money, we, like many other investors, are concerned about what a dollar is going to be worth in this current environment of increasing liquidity. The Federal Reserve of America rapidly expanded their balance sheet was in 2008, printing $1.3 trillion, flooding the system with liquidity. And you can see that in a chart, the top left chart. So this was the perfect setup for a bull run in gold. Gold rallied 155% over the next 3 years after this flood of liquidity. And we appear to be at an almost identical setup, but this time the Federal Reserve balance sheet is coming off at a much higher base, and they've already pumped an additional $2.2 trillion of liquidity into the system. So whilst we like gold as an asset class, it is currently trading right near all-time highs. At Arnott, we're constantly looking for value opportunities where the margin of safety is on our side. So with this in mind, gold miners look to be the perfect value entry into this trade versus owning gold at the current moment. The chart at the bottom right highlights the significant underperformance of gold equities versus the recent rally in the gold price. And the chart to the top right highlights the depressed valuations these equities are trading on versus the broader market, despite a significant near-term appreciation in the underlying commodity price. So in our view, by owning gold equities versus the underlying gold, we have multiple factors working in our favor. We have a structural tailwind for appreciation of the underlying commodity, which they might. Gold equities are trading record low valuations versus the broader market, and a near-term share price underperformance versus the gold price, giving us a value entry point. All these factors lead us to believe that these equities should outperform in the near term, irrelevant of the broader market. So moving on to the short side of our portfolio, despite a sharp correction in equity prices, we're still finding good quality single stock equity shorts in the market. Slide 16 lays out what characteristics we are looking for in equity shorts. So it's pretty self-explanatory, and instead of going through this in detail, I think it would be a little bit more informative to sort of run through a live example of a current single stock equity short we have in the portfolio right now. And this stock's Bingo Industries, ASX code BIN, and this is sitting within our core shorts theme. So this company has all the hallmarks of what we are looking for in an equity short: stretched accounting, high levels of debt, a deteriorating operating environment, and current valuation that's trading at a premium to peers and also the broader market. So since Bingo is listed on the ASX, they have demonstrated impressive headline year-on-year growth rates. However, these headline growth rates have been achieved via mergers and acquisitions and the utilization of creative accounting to pump up the headline numbers which they report to the market. And this has largely obscured the deterioration of their core business, which our analysis suggests that the core business has not only not grown, but likely gone backwards since listing on the market. So headline numbers show 30% growth. Our analysis suggests that the actual core business has gone backwards. In addition to this, Bingo have utilized considerable amount of debt to fund acquisitions and also for reinvestment back into their business, seeing their net debt to EBITDA ratio expand out to 2.2 times. Whilst this doesn't sound onerous, their debt covenants are sitting at 3 times net debt to EBITDA. And in this current environment, that's actually quite alarming, because by our estimates, 30 to 40% of Bingo's business is exposed to commercial activity and also construction activity, which, as I'm sure everyone on this call is acutely aware of, has broadly fallen off a cliff given the COVID-19 crisis. So not only does this put near-term pressure on Bingo's earnings, this also puts near-term pressure on their debt covenants, putting their capital structure at risk. And lastly, in terms of Bingo, they're trading at a valuation premium to both the market and their listed peer Cleanaway Waste Management. And on valuation, whilst we're talking about it, a measure that we typically like to see in companies and like to assess is their free cash flow yield. This is actually impossible for Bingo since they're yet to actually generate $1 of free cash flow since listing on the ASX, which is quite a concerning sign. And so that's a live example of a current short in our portfolio.
So that's where we're going to end our formal presentation and open it up to Q&A. I'm going to start because we had a couple of questions come through from Malcolm. I assume Malcolm's on the line. And Andy, I assume we can't hear anybody, right? So I'm just going to read out the questions.
That's right. You can't hear anyone.
No worries. So Malcolm, you've asked a couple of questions. Some of these are quite macro, and to be fair, probably not questions that we may be trying to solve for, but I'm happy to give you my opinion as best we can. Number one, between stimulus and loan guarantees, America has committed 35% of GDP towards addressing the economic issues of that country. Other countries are generally in the 10 to 12 range. Does this mean the US economy will recover faster? Short answer for me is hard to say. I don't really, I'll answer this more broadly in that I don't think anybody really knows. But what we do know is that we are seeing a extremely major disruption to the global economy. And the analogy that I like to use is that every employer in the world has just had an instant excuse to let a large portion of their staff go. You know, if you're in hospitality, if you're in airlines, if you're in areas tourism directly affected by it, then you've had an excuse to let everyone go immediately. And in answering this question, how are we going to come out of it and how a different countries going to come out of it, then I ask myself the question, you know, when Kenny's coffee shop, which used to employ 10 people, reopens, and let's just say it reopens sometime around August, am I going to re-employ 9 people or 10 people? And I would guess I'm probably going to re-employ 9. And if that's replicated the world over, then there is a huge portion of the population which will not go back to work straight away. And to put that in US terms and try and answer your question, I think it's 47% of people employed in the US are employed by small businesses which operate on less than 2 weeks cash flow. So, you know, they have pumped a lot of stimulus in. They are also tackling this issue probably less aggressively than certainly we've seen elsewhere in the world. And so, you know, how it unfolds in that country is very unknown. The second question is, there are many undervalued assets, particularly in the areas of travel, entertainment, and leisure. Some have fallen as much as 90%. Is it now safe to invest? Well, we think so. We didn't cover this slide, but we are putting longs on around this theme on the basis that although these businesses are currently, you know, in a diabolical state of zero revenue for the foreseeable future, we think they've been priced for somewhat of an Armageddon. So yes, we agree, and we are long the casino operators and Tabcorp holding in that space. Number 3, looking forward, which countries have the highest growth potential? That's probably beyond my skill set. We don't invest by country. We just try and find interesting opportunities. So I'm not sure I'll try and tackle that one. Number 4, with interest rates at an all-time low and likely to remain so for some time, our government budget deficits, I think that's meant to say rising, such a bad thing. Well, I'm going to answer this indirectly. You know, there are a lot of there are broadly 2 commentators in the market now. You know, if, you know, we titled our slide, Are we going to have a V, W, U recovery, or are we going to have an L meltdown? And, I would say that there are probably three groups of people in the world at the moment. There are those strongly wedded to a V-shaped recovery. And I would say the bulk of those people that I come across have a vested interest in a V recovery. They're probably long-only managers. Most of them made a lot of money in '08 buying the dip. Most of them are very bottom-up and very focused on company specifics. Then the alternate view to that are the guys who believe that we're going to have some sort of L-shaped meltdown. I'd say most of those guys are following macroeconomic data, and if I could summarise their view concisely, I would say that they believe that what's happened is the Fed has delivered to the market an enormous amount of liquidity stimulus in the form of people can now, the wheels of the financial system are greased and you can borrow money. But this is not a liquidity crisis. This is a solvency crisis. This is people running out of money and going broke. So they would argue that the central banks and to a lesser extent the policymakers are not necessarily solving for the problem at hand. There is a group in the middle where we put ourselves, where we don't really actually think we know what's going to happen. We're just trying to build a collection of high conviction ideas, and to borrow from Ray Dalio of Bridgewater, we want to build an all-weather portfolio that's going to make it through whatever outcome we have. So, number 4, with low interest rates, should we have high deficits? I could waste endless Sunday afternoons thinking about that. I really don't think I'm going to make any of us any money. It's far more important for us to focus on how we make money in these type of opportunities. We often remind ourselves that, it's our role in this to, play the game and not be the umpire. I'll just see, no, there's no other cues, no other questions queued, guys.
Kenny, I think it'd be worthwhile to touch on, obviously last month you had a good month, up 7%. Not many managers made money in that month. How were you able to do that?
So we run, thanks Andrew, we really run two components in the book. We run an equity short book, which has, a series of themes we've spoken about here. Well, that's a bit quick. These are our collection of ideas, all in the equity book, and then we run a macro trading book. The macro trading book fulfills two roles. It's there to generate alpha in its own right, but in times of market distress, it's there to protect the portfolio. I'm recalling from memory, so don't quote me. Yanni may give specifics, but I would say in March, we probably lost about 5% in uranium, maybe about 2% in our oil book, which was in a Karoon position. The equity book made a little bit of money, but we made all that up. So we must have made over 13% in the macro book, which is trading equity indices. That is typical. In 2007, 2008, we made a huge amount of money. In 2018, when the market collapsed, when overall we didn't make a lot of money, again, it's that macro book. The thing about the macro book is, effectively with one trade, I can move us 50% net short or long very easily. So it's through that macro book. Now, this month we're up about 8%. What's happened this month is uranium, which quite frankly you're all sick of hearing about, has been bleeding us dry for about 18 months, is now starting to turn around. I might make a comment on the timing of uranium. Over a very long period, and I've been in markets since 1990, I look for themes which are mispriced. If you're going to look for themes which are mispriced, then invariably you're going to have to take some pain. Historically, I've been reasonably good at the timing, and I probably only get it wrong by about 6 months. Uranium's probably been my worst call from a timing perspective, and that we've been in it for about 18 months or even longer. And so, yeah, what's happening in April is we're now seeing some of our laggard positions performing well. You can see this. You can see we're sitting here right now short from an equity. Sorry, we're slightly short, no, just slightly long overall, but very short on the index position. I would say, and we'll, over the course of the next 12 months, you're going to hear me change my mind a lot trading around what we think the news flow is. We're pretty good traders. We're going to be active in markets. I just put up a sobering chart for any guy, and I'm not in the bear camp. I want to make that clear. I genuinely don't know, but, I just like to put up a sobering reminder for anybody who tells me we're going to have a V-shaped recovery. This is what happened in 2000. We fell 37% and then we rallied 33. Funnily enough, that would put us right here, right now, if we're going to replicate what happened in 2000. Everyone's going to tell me that it's not 2000. I'm not disagreeing with that. I just want to point out that markets, markets can certainly go down a lot from here if we end up with a situation where Kenny's coffee shop actually only employs 8 out of 10 guys when I go back to, trading. I'm not sure whether you got anything else you want to cover off on, Andrew.
What in terms of the Australian market, what sort of flows are you seeing? Are you seeing redemptions, or are you seeing sovereign wealth funds re-enter the Australian market and participating in these recaps? I mean, because I guess that determines how these placements are being taken up as well.
Yeah, I think going on previous cycles, if we cast our mind back to 2009, every cycle is different, but I think what we're seeing at the moment is massive appetite for the raisings, and we're seeing those raisings are largely going well. I would say that our team, Yanni and I, have done a significant amount of work on who we thought were probable raisers. And I'm pleased to say that I think we've got a 100% track record of getting it wrong so far. Is that right, Yanni? I think that's right, isn't it?
We've missed almost all of them because it's yeah.
And really what that tells you, QBE didn't really need to raise money, and they did. I think what that tells you is we're all probably going to be surprised either how much trouble a lot of companies are in that we weren't aware of, or how people are going to opportunistically raise money. I suspect it's a combination of both. And the bottom line is that there's probably going to be a lot more raisings to go on globally for a lot longer. And, ultimately that uses up demand. And so, I'm very, very cognizant, and we're very cognizant of being cautious on raisings, because at some point they're going to be mispriced and they're not going to work, and you won't be making money out of them. But as a general comment from a flow perspective, I would also say people talk about, there's so much cash on the sidelines. This comment's referred to regularly. When people don't think markets are going up, it doesn't matter how much cash is on the sidelines. It's not put to work. Another comment worth talking about on supply and demand is that over the last 5 years in the US market, the only net buyer of equities has been buybacks from corporates. And, there are no significant buybacks from corporates going on right now. So that's an area of demand which has also gone from the market at a time when there's increasing demand by corporates on the raisings, which is soaking up cash on the sidelines as well. So, it's, I just sort of probably, as a trader, which I am, I just really struggle to see how we're going to get through new highs, given what we know right here today. We've got NASDAQ, we've got some names in NASDAQ trading above valuations, but then, on the flip side, we've got names like some of our consumer names, which we think have just been decimated, and people, really are not prepared to look through. So we just feel pretty relaxed that there's a whole bunch of ideas on the long side, which are beaten up. We can put on. Our ag theme is really simple. It's uncorrelated generally with market returns, and we're pretty excited about what we see out there. Shorts, when markets come off, shorts are always a bit trickier. But we've got a group which we didn't speak about, our defensive sector, and our defensive sectors. 1 second, let me get back to. Sorry, guys. Oh, goodness. Got my training reels on here, don't I? Okay, let me just come back to this one. You know, ResMed, very good company. You know, we're not a company at all that we have any question marks over about the business model. But, you know, this company is trading almost back at record valuations, almost back at record price. Some of that is on sentiment that they're going to be able to deliver revenue from some COVID-19 ventilator sales, which certainly are not coming through at this stage. So, you know, that's a really interesting situation where we also think the supermarkets in Australia are being priced as though they, you know, almost can do no wrong. And while we think there's absolutely nothing wrong with that duopoly business model, we really like it. We think there's a price. There is a price. You've got to be careful that you pay for that. So, you know, under a scenario where markets chop around sideways, then this combination of portfolio being short high valuation names and short low valuation names typically does pretty well.
I think lastly, Kenny, I think everyone's always asking about the Australian financials, mainly the banks. So any thoughts on that, and as well as how liquid is your portfolio? I mean, how quickly could you close all your positions?
Yeah, so on the banks, first of all, I mean, I think that, you know, back to the old adage that if you borrow too much money, it's initially your problem. If we all borrow too much money, it's CBA's problem. And if the whole of Australia's borrowed too much money, it's the government's problem, which is our problem as taxpayers. That's the situation we're in. The government's made it very clear that everyone's going to share in this pain, and financial institutions will be part of that. You know, I see financial institutions now as effectively a conduit for delivering government policy. And under that scenario, something like CBA, which is on 1.7, Yanni, 1.7 times book, roughly?
About 1.6, I'll double check right now.
0.6. You know, I just fail to see how a bank which is delivering government policy can trade on a valuation like that. So they're not all, some of the other banks, in fact, all the other banks are trading below book, so I wouldn't put them in the same category. We don't think they're, I think probably most of the banks would put in no man's land. CBA, we just think is trading too expensively. To the second question around liquidity, we made the tough call in January and February, which cost us performance to rid our portfolio, not completely, but to a very large extent of small cap and illiquid positions. We don't want to delve back into that area for some period to come. I think the small cap space in Australia is a quirky place to invest at the best of times. And over the last couple of years, we've seen this enormous transition where we've seen redemptions from specific small cap managers, and he's been brought back in-house to a lot of the industry funds who are now redeploying that. And we don't really know how they're going to redeploy that capital yet. But historically, once we've started to see an underperformance in small caps, it can linger for many, many months. And given that I feel we're kind of anchored now towards the end of financial year, I really wouldn't be surprised to see, you know, small caps from a flow perspective linger, you know, until the end of June. So it's an area that we want to stay well away for the moment. I mean, you know, we've been pretty good through different market cycles and different parts of the cycle to move around our liquidity. And, you know, I think if the best point as a trading investor to be in small caps is as you move from the, you know, if we think about an investment clock from the early stages of recovery through to the mid stages, that's when, you know, you can really get a lot of alpha out of small caps. You got to be very careful being invested there late cycle. And what I would say is if you're invested in small caps right now, you're probably not going to get out of them because there's not enough liquidity to get out of them.
Great. Kenny, do you have any more questions that have been sent through online?
Let me take a look. No questions. So I guess at that point, we'll wrap it up, shall we, Andrew?
Yeah. Thanks. Look, thanks, Kenny. Thanks, Yanni. Really appreciate your time and keeping us informed. We really appreciate it. And if anyone's got any further questions, they can email through their advisors, and we'll make contact with either of you to hopefully answer them.
Yeah, and if you'd like a copy of this, if you'd like a copy of the slide deck, we can send that through. Just you let us know, Andrew, whoever needs a copy.
Perfect.
All right. Well, thanks very much, everybody.
Thanks, guys.
Thank you.